Hello and welcome to the world of Kelp Decoding Investments. My name is Arpit Agarwal and we are going to help you demystify this complex world of investments, whether it's investments in mutual funds, equities, fixed income, derivatives, commodities, or even foreign exchange. We will bring you a series of videos on Kelp Decoding Investments, which is an app on the Play Store and on the App Store. And it's also a YouTube channel called Kelp Decoding Investments. In the very first video that we bring to you, we will demystify the world of Indian mutual funds. The total AUM of 23,92,915 odd crores is divided into these 5 categories as defined by SEBI: equity, debt, hybrid, solution oriented, and others, which constitute ETFs, index funds, and fund of funds. 46.7%, which is the largest portion of this AUM, is in debt funds, and almost 31% of the AUM is in equity funds. Hybrids, solution oriented, and others account for the balance 22 odd percent. 42% of the AUM is held by corporates and financial institutions, and 58% of the AUM is held by individuals. When we look at subcategories, a majority of the debt AUM is held by corporates and a majority of the equity AUM is held by individuals. How many of these schemes, or how many of the total schemes that exist in the Indian mutual fund industry, have completed 10 years of existence, and how many have completed 20 years of existence? There are 62 primary schemes that have completed 20 years. What does primary scheme mean? A mutual fund scheme may have many variations like dividend reinvestment, growth, or dividend payout. But in the end, it is one scheme. So when we talk about 62 schemes, we talk about one of those schemes and not the variations that are included along those schemes. So 62 funds or 62 schemes have completed 20 years, and 531 schemes have completed 10 years. Looking at the 62, we find 36 equity funds have completed 20 years, and they have delivered an average return of 17.5% during this period. Now, when we talk about average returns, these are point-to-point returns, which means returns from the 1st of April 1999 till 31st of March 2019. And we look at 10-year returns, they are from 1st of April 2009 till 31st of March 2019. While the average shows at 17.5%, in a subsequent video, when we dig deeper into specifically the equity category, you will see the returns vary from less than 17.5 to more than 17.5. And if you had invested equal amounts in all of these 36 funds for a 20-year period, the average return on your investments in each of those funds in equal amounts would have given you a return of 17.5%. In those 19 debt-oriented schemes, your average return would have been 8%, and the table is self-explanatory. Now, there is no guarantee that you would generate the same return in the future if you hold it for 10 or 20 years, but it gives you an idea of what kind of difference of returns you have across different categories of schemes. In the next few slides, we dig deeper into each of these categories and explore the risks associated with investing in each one of them and the SEBI regulations on investments for each of those funds. The first one is equity, and in equity there are further sub-classifications. The classifications according to SEBI are multi-cap, large cap, equity-linked savings schemes, mid-cap, value, large and mid, and so on and so forth. At this point, I would like to bring to your notice that all the listed companies on the Indian stock exchanges are divided into 3 categories: large cap, which are the top 100 companies by market capitalization. The next 150 companies are called mid cap, and everything else, which could be in the region of 4.5 to 5,000 odd companies, are called small caps. And SEBI's classification and recategorization of mutual fund schemes puts in the regulation as to which category of fund or which category of or class of fund can invest in which of those market cap related companies. So if you look at the small cap category, minimum 65% of the AUM has to be invested in small cap equity only. If you look at the regulation around multi-cap funds, the SEBI regulation is minimum 65% of the money in that scheme has to be invested in equity. But SEBI does not put a restriction on market cap, which is whether the stock that you're investing in is large cap, mid cap, or small cap. So long as 65% of the money is invested in equity across any cap, the balance 35% could either be invested in equity of any cap or even fixed income. In the previous table, we saw that equity funds gave an average return of over 17.5% for both 10-year and 20-year period. While the returns have been extremely high and they are not guaranteed to be the same in the future, equity investing comes with a risk associated with it. And what is the risk? There are many risks associated by investing in equity, but the three primary risks that we will cover in this video are market risk, business risk, and liquidity risk. So what is market risk? Now the BSE Sensex has grown from a base of 100 in 1979 to 39,000 in 2019. And this hasn't been a straight line. Markets move up, markets move down, sometimes extremely sharply. That is called volatility, and we'll explain that in a subsequent video. Now what happens when the whole market moves down? And some of you remember 2008 when the market moved down by over 50%. Irrespective of the stock that you were holding, a majority of them lost value. And in 2009, when the market rebounded sharply, many of those stocks went up. Now the business hasn't changed, or the business revenues may not have changed, or the profitability of that business may not have changed. But because the market moves up or down, the value of your investments may also move up or down. That is called market risk. The next risk that we move on to is business risk. What is business risk? Business risk is the risk associated with a specific company. So even if the whole market is going up or the whole market is going down, it's possible that a specific business is facing a phenomenal run, increased profitability, and in a falling market, that company could be rising. Or vice versa, that the whole market is rising, but a specific company or a specific industry is facing headwinds, and the stocks of that company or the stock of that company or the stocks of that industry will face headwinds and head downwards. We saw this in the pharmaceutical industry, where the Sensex and the Nifty in the last few years went up, but the pharma company stocks went down. Last year in 2018, we saw the IT companies do extremely well, and even though the markets overall didn't do very well, some of the IT companies did really well. In the last few months, we have seen that the markets may have done well, but some of the automobile industries may not have done well, and some of the companies associated within the automobile industry have corrected by over 35 to 40%. That is business risk. The last major risk that we cover in this category is liquidity risk. And what is liquidity risk? The liquidity risk is the risk that a specific company stock faces when there are not enough buyers and sellers of that same stock in the market. So if a stock is not highly traded, then it's possible that when a fund manager wants to buy larger quantities of that particular stock, the price may get impacted because there are not enough suppliers. Likewise, when a fund faces redemption or the fund manager has to sell a particular stock based on the investment objective of that stock, it is possible if the stock is not very liquid, the fund manager may not be able to take advantage of the price that exists at that point in time. So market risk, business risk, and liquidity risks are the three risks that you have to keep in mind while investing in equity. We will now see how each of these categories of funds have performed over the last 10 years and the last 20 years on the same point-to-point basis. And if you look at multi-cap, which has the largest share of the 7,38,000 odd crore AUM of the equity funds, is roughly 21.3%. Large cap takes about 18.5%, equity linked saving schemes is about 13%, mid caps at about 10.9%. And the rest, as per the table, take a much smaller share of the AUM. Funds like dividend yield funds, which focus predominantly by investing in dividend yielding stocks, takes the smallest share of the AUM at less than 0.7%. So 7 multi-cap funds, 6 large cap funds, 8 ELSS funds, and overall 36 primary schemes of equity funds have completed 20 years. And that gives us a very good idea how equity funds perform over reasonably longer periods of time beyond 20 years. So we saw in our first table the average returns of equity was a shade better than 17.5, but when we dig deeper into the specific components, we find mid caps have probably given the highest returns, even higher than small caps. Small caps didn't exist for 20 years, but as you jump to 10 years, you will see small cap funds, 8 of them have completed 10 years, and 18 mid cap funds have completed 10 years. But mid caps have outperformed even the small cap funds. In a subsequent video, we will dig deeper into each of these subcategories, and within each of these subcategories, we will bring to you performances of individual fund schemes over 10 years and 20-year period. So in conclusion, equity as a whole is a much higher risk asset class to invest in, but when the investment period is long term, 10 years, 20 years, it adequately compensates for the additional risk that you take in investing in equity. Let us look at the largest AUM share of the Indian mutual fund industry, which is taken by debt or income funds, as they are called, of roughly 11,18,000 crores. This is a much longer list of classification and recategorization as per SEBI, because SEBI has tried to segregate these funds to identify some of the risks associated with investing in fixed income. The 3 primary risks that you face by investing in income funds are interest rate risk, credit risk, and the liquidity risk, which we already covered in the equity component. So let's look at the interest rate risk and let's look at credit rate risk. Now, if you look at this list of funds, it is going from funds which are called overnight funds, which invest in securities with a maturity of 1 day, to long-term funds which invest in debt and money market instruments with durations of over 7 years. Some of you may already know that bond prices are inversely related to interest rates. So when interest rates rise, bond prices go down, and so does the net asset value of the fund, and vice versa. And a bond with a much longer maturity period is more sensitive to changes in interest rates than the one with a shorter duration. And to understand debt funds better, SEBI's new norms of categorization require fund houses to classify their debt schemes based on what is called the Macaulay duration. What is Macaulay duration? Macaulay duration is named after its inventor, Frederick Macaulay, who was an economist, a very noted economist, who invented or who created this Macaulay duration concept way back in 1938. So Macaulay duration is the time an investor will take to get back all their money in that specific bond by way of interest and principal repayments. So the Macaulay duration of a portfolio of bonds, which is a mutual fund scheme, is calculated as the weighted average Macaulay duration of the entire portfolio. So by looking at the different categories of funds, you will invest in an overnight fund if you don't want to take any interest rate risk. But if you're taking or investing your money in a long duration fund, which has a maturity of more than 7 years, then you're taking a much larger interest rate risk. So if interest rates go down, then the NAV of long duration funds will typically go up much faster or much more than the NAVs of a money market or an overnight fund, and vice versa. The second risk is called the credit risk. And credit risk is a risk that the bond issuer will fail to make payment of interest or principal at the time they have promised. So if you've bought a bond which has a maturity of 10 years and it pays interest every half years or every 6 months as they call it, the risk that the person or the company that is issuing the bond fails to make the interest payment every 6 months or even fails to make the payment of principal at the end of 10 years. That is called credit risk. When we look at some of the funds and we go down to a fund which is called Gilt, which invests minimum 80% of the AUM in government securities across varying maturities, we understand that the credit risk is significantly lower because government securities are sovereign paper, which means they are issued by the government of India and they are virtually risk-free. But while being virtually risk-free, they still carry an interest rate risk. So you may not have credit risk on government securities, but you may still have interest rate risk, as when interest rates go up or down, the value of the government securities may change, and therefore the net asset value of the fixed income fund investing in government securities will change accordingly. We now look how that 11,18,000 crores has been divided into various fixed income or debt fund schemes. And looking at the division or looking at the AUM under each subcategory, we find that a majority of the AUM is concentrated towards the lower end of the duration, which is up to a duration of 3 to 4 years. The largest share of the AUM is in liquid funds, approximately 35%, and the maturity of all liquid funds is capped at a maximum of 91 days. The long duration funds or the medium to long duration funds have less than 10,000 crores of the total 11,17,000 crores of AUM that exist. We had mentioned in an earlier part of this video that a large component of the fixed income market is subscribed by companies and financial institutions. And companies and financial institutions, instead of putting their money in current accounts, choose to invest in income funds, liquid funds, overnight funds, money market funds, and shorter duration funds to manage their treasury requirements more effectively. Gradually, this trend is picking up with individuals and high net worth individuals too. People are moving their monies that they have kept in their savings accounts or some of the monies that have been kept in their fixed deposits into fixed income mutual funds for the reason of liquidity and slightly better returns over the long term. In our first slide of returns and number of schemes having completed 10 years or 20 years, we saw that in case of income funds, the average return for 20 years was approximately 8% and the average return for 10 years was 7.6%. As you spread that into subcategories, we see that the returns change. Gilt funds, which have some of the longest duration while carrying extremely low or negligible credit risk, have given higher returns. When we do a detailed video of investing in debt funds, we will dig deeper into each of these subcategories and even bring to you individual schemes and their performances over 10-year and 20-year period. But data presented here is to give you a broad picture of how fixed income has behaved across categories and across 10-year and 20-year investment horizons. This will help you decide your fixed income strategy or the money that you choose to allocate to bank fixed deposits or your savings or current accounts. It will also help advisors to recommend the right kind of product based on the risk return or the risk profile of their investors and how much credit risk or how much interest rate risk is that particular investor willing to take. The third segment of the Indian mutual fund industry is what we call the hybrid fund category. And the hybrid fund category has 3,71,000 crore odd worth of AUM in its segment. Now, what is hybrid? Hybrid is nothing but funds which invest in a combination of debt and equity. And if you look at SEBI's categorization of the hybrid funds, we find that the hybrid funds vary in these categories, which is conservative hybrid, which invests predominantly in debt, which is fixed income, between 75 to 90% of its AUM, and the balance 10 to 25% is invested in equities. While aggressive hybrid, on the other hand, invests in debt of only 20 to 35%, while 65 to 80% of the AUM gets invested in equities. Looking at their returns of 20 years point to point, only 4 schemes or 4 primary schemes in the aggressive hybrid category have completed 20 years, and the average return that they have given during this period is in the region of 15.9%. Moving on to the 10-year point to point, there are much more. There are 59 schemes that have completed 10 years. And as we can see, the 59 schemes, the return vary from 7% from arbitrage funds to as high as 16% in the balanced hybrid category. If you recall, in our first slide, we have indicated the average of the hybrid category for the 10-year point to point to be approximately 11.3%. So while the overall hybrid category, or all of these schemes, 59 schemes, have delivered an average return of 11.3%, the returns vary from 7% to 16%. And in a subsequent video where we just cover hybrid funds, we will go into each of these subcategories and start looking at specific schemes in these categories to see how within that category the returns have varied from scheme to scheme. What it helps you to do, that if you don't want to go pure equity or you don't want to go pure fixed income, but you want a professional fund manager's help from a reputed asset management company, you can just choose a hybrid fund based on your risk profile. So if you want to take a lot more risk, you can go to hybrid funds with a higher allocation to equity. And if you want to take much lower risk, you can stay with hybrid funds with a lesser allocation of equity. This covers the 3 major categories of AUM in the Indian mutual fund industry, which is equity, fixed income, and hybrid. And the balance 2 are solution oriented and others as classified by SEBI. The Indian mutual fund industry has a long history. The first mutual fund company that was set up through an act of parliament. It was called the Unit Trust of India in 1963, and they launched their first fund in 1964. It wasn't until 1987 when public sector companies launched their funds, and in 1993 we saw the launch of the first private sector mutual fund from a company called Kothari Pioneer Mutual Fund. And today, which is end of March 2019, we sit at an approximate assets under management of the industry of 24 lakh crores. And this had hit a high of 25 lakh crores in 2018. What a phenomenal growth it has been in the last 26 years, from the launch of the first private sector fund till today. And I have been associated with this industry for the same period. When the first private sector mutual fund got launched, I was working for a company which was the lead manager to that new fund offering, and I went across the length and breadth of this country and to a few countries in the Middle East to market the first private sector fund to hundreds and thousands of investors. I have personally invested in Indian mutual funds, and I have also recommended through a detailed analysis these schemes to tens of thousands of investors all across the country. And Kelp Decoding Investments aims to bring my experience and the experience of my colleagues who have collectively put over 75 years in the Indian financial services industry. That brings us to the end of this first video, and I hope that this will help you make more informed investment decisions, and by now you are better informed in terms of what kind of risks that are associated with each category of fund and what kind of returns have these funds delivered over 10-year and 20-year period. Keep watching our videos, and please remember that mutual fund investments are subject to market risk, and you must read all scheme related documents carefully before investing, and invest based on your risk tolerance and time horizon. Our email ID is help@kelpmail.com. You can write to us if you want us to make more videos on any specific category that you want to know on, or a specific investment product that you want to learn about. We are on the App Store and Play Store as Kelp Decoding Investments, and you can write to me directly on Twitter or Facebook using my handle @Coach Arpit.